Welcome to UBK Hian CIO Series number 35. Today we'll be discussing US market outlook. My name is Wang, CIO of Private Wealth Management, and along with me is our new US strategist, Wendy Chen. Welcome, Wendy.
Thank you, C.
I will introduce Wendy in a second. And Wendy will be our main speaker today, carrying out a discussion with me on what's happening in the US market, particularly in some of the high growth, high beta AI stocks in relations to both the industry as well as the macro risk. Standard disclaimer, some of you may have seen this already. And like I said, today, we're going to dive deeper into the US markets, starting with Wendy give us an overview of the US market dynamics today. And then we will move forward to what we think will be the 5 most important drivers for the market in the second half of this year, including the geopolitical risk in the Middle East, and the midterm election, I believe, is in November, right?
In November.
And one of our top predictions for 2026 about the Fed Wildcard, which is also playing out as we speak. And then also very important and related to the Fed policy is the US macro data. And last but not the least is the AI industry fundamentals. Especially, we're going to talk a little bit about Nvidia earnings tonight. I think it's just a few hours. So very timely to have this conversation. As usual, we'll have the Q&A at the very end. And with that, let me introduce Wendy, who just joined our firm recently, replacing Paul Davino, our previous US strategist, who is retiring at the end of this month. Again, it's very glad to have you here, both in our firm and on this webinar. And from reading Wendy's CV, you can see that she's a very experienced investor covering both US and China markets, have worked in some very respectable shops, from Goldman Sachs to GAM to large family offices, or you even worked in a hedge fund.
Yes.
You can maybe tell us later about your experience there. Wendy, do you want to give a little bit intro by yourself?
Sure, of course. So, hi everyone, I'm Wendy Chen. I'm a Beijinger growing up in Hainan Island, where the chicken rice coming from. I'm an economist by training, so study economics in both my undergrad and the graduate school in Peking University and Johns Hopkins. And after that, venture into the finance realm, looking at growth equity in both US and China across multiple shops. So yeah, I've been on the sell side and the buy side, been with patient capital as well as, day trader, as well as seeing the bull market and the bear market. Hopefully that spread can help me navigate better in US market in a different time.
And you definitely joined us at a very interesting time. I remember the first day you joined was over the weekend of the Iran strikes. So that was around the end of February?
End of Feb, exactly. Yeah.
Okay, so our main topic is about, I guess, just not US markets. Look around, except for China, many of the global markets now at the market, are at the record highs. Maybe Wendy, can you give us some overview of what's going on around the world so we can have a more holistic sense of what's happening, and also maybe help us understand what's been driving this rally. And apparently we've been too conservative, as you know, year to date about the US market, while the market is now at a record high.
Yeah, absolutely. Thanks, T. So if we look at this chart, this is the site as of Thursday, May 14th, last week. So this is when S&P touched that magic number of 7,500. And this is the year-to-date winner in the global cross-asset portfolio. aka kind of like the money I should have put in the beginning of the year.
Yeah, it looks great.
Yeah, and as you can see that the growth equity with the heavy tech weighted are definitely the front runner. See Korea, Taiwan, and maybe partially Japan, emerging market, NASDAQ, and even S&P are all performing actually at a faster speed than the previous first half. So definitely AI and technology is the front runner. But if we actually put another indicator into that, this little box up there is the relative strength index, or RSI, over the past 14 days for all these major asset classes. As you can see how, well, maybe a quick introduction to this. So anything above 70 in this index pretty much means that this equity or this asset is overbought. Anything below 30 means it's oversold. And in a bull market, even crazy bull market, over 80 can means overbought. So as we see in the index here, in the chart here with all the red highlighted, many of them already hit the level. The way I would describe RSI metaphorically is, imagine this is the heart rate of some really good athlete or runner who just finished their 100-meter sprint. Doesn't mean that it cannot keep on running, but when your heart rate is that high, it pretty much means you need to catch a breath. And that's what we're seeing over past 2 trading days, that all those high flyer with ultra high RSI are actually taking a breath, which gave us the opportunity to take some profit beforehand, as we did in our model portfolio.
Yeah, I guess for Korea, it's not just a market overheating because of all the AI-driven economy. I mean, you have some personal first-hand experience with South Korea recently, have you?
Yeah, exactly.
Yeah, you were there, and then what did you see?
Well, it's definitely consumption is booming. I can tell the consumer made a lot of money from their leveraged bet into the equity market. And we can pretty much say this is driven by 2 stocks, Emily, Hynix, and Samsung, right? So maybe just a little bit dive deeper, is there's any ground in this crazy bull market we're seeing? So one thing that's maybe counterintuitive since the Iran war, since that Hormuz block is still ongoing, so people think that naturally it's going to impact costs for everybody around the world. However, if we look at the US and especially S&P, ever since the Iran war, the S&P of US actually, the earnings revised up, not down, 5%. Before this earnings season started. And if you look at the breakdown, majority of that upward revision coming from, well, no doubt oil, obviously, but also semiconductor and tech. If we look at maybe the next slide, so this kind of like stuff specific one tells a clearer picture of that. Pretty much the majority of the earning upward revision is contributed by technology and energy.
Yeah, that's a good point. Could be one point that we missed. Of course, the analyst revision is always difficult to predict, but looks like Wall Street is not too worried about the oil shock, the macro risk, or any slowdown in AI spending, that kind of things.
Exactly, and this euphoria actually have some ground, because now we're closing to the end of this earnings season, and among those S&P stocks actually reported, 80% of them actually report a beat in their EPS and the revenue over the past, even after this upward revision. And that's for the first quarter in 2026. So overall index EPS growth is actually 27.7.
Yes, well, there's some one-time effect there, but even removing those one-time effects by Google and I think Meta, it's still 13% growth year over year, which is extraordinary, I think.
Exactly.
Yeah, so I think that explained it. The part of I guess the earnings fundamental is a remaining bright spot supporting U.S. equities.
Exactly, and even with the Iran war, this is probably the comparison chart tell it better. This chart is what we see, the global cross-asset performance before the Iran war. That's basically January and February. And then these are the chart after the Iran, not say after the war, but after the ceasefire in the end of March. You can tell the rankings pretty much look exactly the same.
Sure.
So it's kind of telling that even though the Iran war disrupt the asset performance, after kind of like taking a breath, they all pivot back into fundamental driven.
So the Iran war is just more like a pause button. Whatever the trend existed prior to the conflict now has resumed.
Exactly.
And probably even stronger, looks like.
Exactly. And of course, there are questions that, yes, the earning fundamental is great, but is that by itself enough to drive such a market outperformance or this crazy bull? So maybe just to add fuel into that, this is something I always like to highlight to the long-term participant of the market. So looking at the past 10 years of S&P performance by factor, basically by driving forces, of course, the past 10 years, one factor that gives you the highest return will be earning revision. Yes. Understandable. That's fundamental. That's cross-cycle. You make more earning, you deserve higher valuation. Easy. But however, if we look at what happened in the past 1 year as a comparison, you see that momentum factor, basically people chasing or not really buy low, sell high, but buy high, sell low, that's a factor is actually catching up to be a tie number one with earning revision. And that is a result of the changing dynamic of the market participant. As we see, patient money is still there, but definitely more participants such as systematic trading fund, trend following fund, leverage hedge fund, and of course, retail, which surprisingly, even though their asset side by itself doesn't seem as big compared US retail compared to China retail. However, their trading volume is now already close to 20% of the total trading volume in US.
Yeah, we can attest to that as well as a brokerage firm ourselves.
Oh yeah.
We also see strong flows into the U.S. stock business. A lot of it's retail, some of it's family office, and some institutions. But all in all, I think this retail participation is now seems like a dominant force in U.S. stock market, which makes the game more momentum driven, as opposed to earnings or fundamentals driven, even though first quarter earnings are still very solid. So if I may to recap, the momentum doesn't really mean that it's going to reverse. It could continue. It's just that these things tend to just carry some risks to it, I suppose.
Basically, market, when they go in one direction, historically might be unwinding, but nowadays it can actually go to extreme before it hits.
Yeah, so the pendulum swing, we often say.
Exactly.
Okay, so that is a very useful recap of, I would say, the U.S. market for the past 5 months, year to date. So on the outlook, and Wendy and I have discussed this in length, about what will happen next until the end of this year and even beyond. And as I said earlier, we listed 5 factors, including earnings and AI, that will continue to shape the U.S. market. And even though we said earlier that the market is not pricing in the Iran war risk, the market is just focused on earnings, and also there's a bit of momentum going on. But the fact is that the war is still ongoing and there's no end to it. And we've been saying this over and over, that in this matter, Israel, in fact, it is still the key to a peaceful resolution to the war. Here, I just randomly picked 3 pieces of news over the last 3 months since the war started. In the beginning of the war, U.S. officials accidentally disclosed that U.S. was force-handed into this war by Israel. Now, whether there's any interest or any cohesion or kind of a force involved, we don't know, but there's been well reported that the U.S. may be dragged into this war by Israel. And then you can see on the date of the peace ceasefire, I think it was April 8th.
Yeah.
Israel not only did not acknowledge the deal, but also started to strike another country, Lebanon, one of the biggest strikes to Lebanon in the last year or so. And this is on the right-hand side of the most recent news about how Israel is continuing to be giving out this message that they're not willing to finish this yet. So that gives us a bit concern over how long this war will last, and this means oil price may remain elevated. And then later we'll ask Wendy to give us some insights on the macro data, especially on inflation.
Yep.
Any thoughts on this?
Yeah, I totally agree. I think when seems like both sides and everybody acknowledge that Trump definitely wants this war to end, even though he started it, since his popularity have already been on free fall into this year. And he has a good reason to trying to stop it. If we look at the key timeline for Trump, other than this Iran crisis, this is the year of midterm election for the US. So maybe just let me dive into that a little bit. So it's not about Trump being the White House, because we're still going to be with Trump in the next 2 years. Midterm election is about the House of Representatives and the Senate being re-elected. So right now, Trump having a very comfortable situation of all White House, House of Representatives, and Senate are receiving majority by the Republican. However, in this upcoming middle of November, that potentially is changing. If we look at these are the two pie chart on top of the House and the Senate, that is the market prediction, aka polymarket prediction, on the who is going to win over in this upcoming midterm.
Yes.
In the House of Representatives, already 80% of the chance Democrat are going to take that from Republican. And that's not surprising, because
not surprising at all.
Yeah,
I think it's not just Democrats. I think with the war, Trump has angered the MAGA crowd and all the right conservatives, and I don't think they want to get involved in this war. So maybe there is a connection between that and the midterm election and Trump's popularity, and now the higher gasoline prices and inflation pressure. Also not good for voters, I guess.
Exactly. And ever since World War II, actually, there's what we call the midterm curse. That's the ruling party tend to lose the House during the midterm election unless you do a very, very good job. Yes. And actually, to divert that back to the first round when we have Trump 1.0, that time the midterm election was in 2018, and the Republican also lose the House of Representatives back in then. Senate is a little bit half and half, 50% chance they're going to keep, 50% chance they're going to lose. So that basically means that if I put that into the historical dynamic, so last round when we have Trump in 2018 midterm election, Republican lose the House of Representatives, but keep the Senate. So how does the stock market react back then? Kind of like I read across this time. Before the midterm election, in the second half of 2018, the market crashed. Well, I wouldn't say crash, but see very strong volatility. And S&P end that year in the minus category of minus 2.5%. However, right after the midterm election, when all the kind of like a result is clear, who is controlling what, market have a very swift comeback. Yes. And ending 2019, guess what? Surprisingly, almost 30%.
Yeah.
So that's kind of like we say there's a midterm election curse for the ruling party, but midterm election blessing for investor. Basically, historically, after midterm election, S&P always outperformed the year than the year without the midterm election because of clarity. And that's what the market
stability.
Stability. Exactly.
And we already see that in the UK market, because UK, I mean, maybe not exactly comparable, but UK now have political instability. They have uncertainty regarding the prime minister, and the markets did not take it too well. So to say the least, right, Wendy, that even if the prediction is wrong, even if that the Republicans could win back the House and the Senate, and there's still a lot of uncertainty with respect to, generally speaking, historically.
Yeah.
the market goes through a period of volatility ahead of the midterm election. So that means from now to November, the market may remain volatile.
Exactly. And as pretty much all the politicians need to advocate voters to come to vote for them. So you're going to hear some really crazy claim from now on to November as people try to catch eyeball.
Yes. And then according to our framework, I guess the uncertainty is not just the midterm election, but also what we call the Fed Wildcard.
Exactly.
So can you talk to us about what does it mean now we have a new Fed chair? I'm sure everybody wants to know because it's like always a hot topic.
Yeah.
Kevin, our new Fed chair, what is he going to do, and whether, how the market would trade from there?
Yeah, so I think there's already a lot of discussion of who Kevin Walsh is going to be and how is his preference. But I think it's not really about at this point whether he is, as some Republicans say, the Democrats said, Trump sock puppet, or he is really the hawk, as he did back in 2008. The whole point is when he stepped into and he was swearing into the Fed chair this upcoming Friday, when he comes to the Fed, he is facing the most split Fed we ever seen since 1990. So basically, if we look at this is a very broad based on the recent split of the Fed Fed member, where there's FOMC member, where they stand. And it's pretty much telling that whichever side Kevin's going to take, it's going to tip the scale.
Yeah,
so
determining factor.
Exactly. So that's why I think in both his recent inauguration as well as his debates before coming in, he trying to stand in the middle ground without giving too much view of whether he's a dove, he's a hawk, because it can very easily tip the scale to one way to the other. And also, I think, also from a historical perspective, after the Fed chair being changed, there also going to be some market volatility as they are basically doing the guessing that whether he's going to cut rate immediately or he's going to hike.
Especially when the Fed is so divided.
Exactly.
You can take. If I were I would. I can argue for both sides. I guess there are enough arguments on both sides about policy direction.
Yeah, and maybe just one thing I want to say, coming from an economic background, that there are always arguments that we see the inflation being red hot. So how come Fed? Remember, Trump also used to call Mr. Powell Mr. Late. How come Fed is always so late in terms of responding to macro situation? Well, coming from, if we go to the next slide, coming from the macro background, Fed there's a kind of like a market misconception about what Fed can do. They always say that when inflation happens, that Fed, by changing their rates or the policy rate or monetary measure, they're going to impact inflation. Not exactly. So basically what Fed do is through the monetary and the credit measure, they kind of like impact the real economic of real economic activity. And through that, let's say if Fed hikes rate, corporate find it's more difficult to raise money to expand, so likely you're going to see more layoff in the market. More layoff mean less consumption power, and less consumption power will tame inflation. That's almost like a domino historically what Fed can do and eventually impact inflation. It doesn't work in reverse. That's why Fed actually learned the lesson the hard way back in 1970 with the first oil crisis we saw. That's because of the external shock of oil inflation, the inflation jumped crazily. However, economic activity was so weak that when Fed hike rate back in that time, it pulled the entire U.S. economic to the worst nightmare it ever had, stagflation.
Yeah.
So
which we've been watching, by the way.
Exactly.
And in fact, I would say, well, back to the Iran situation, we're now probably having the largest oil shock in history.
Yeah.
Even worse than the 70s. Plus, we have other interfering factors such as China, AI, and geopolitical risks. So I would say, based on your framework, the Fed probably even have more challenges
exactly
before.
And the macro data is telling us that's a factor specifically. As I mentioned, when we're looking at the US inflation, don't trying to dive too deep into the macros, but basically the number one leading indicator everybody see now is the gas price. And the gas, on the ground.
It's up a lot.
Well, on the ground, the gas price is actually even more shocking than the future because if we see ever since the Iran crisis, US on the ground gas price actually rise 50%.
Yes.
And it's standing above $4.5 per gallon. And that was last time we see that level back in the Russian-Ukraine crisis.
Yes. And again, this kind of demystified that, when the war first started, I read that people think, well, the U.S. is going to benefit, they're exporting oil, and the U.S. is immune. Apparently, it's not.
Yeah.
So there's structural problem with the U.S. economy, such as the refinery capacity, environmental impact, and all these things combined make it U.S. maybe equally vulnerable to the oil shock, which is evident in these numbers. And you also have a manufacturing index here. Does that show that the oil shock may also have a negative impact on production?
I think that's actually a very good point. So we see that the oil shock have already pushed up inflation as shown in the CPI.
Yeah.
And of course, the lower quartile, a consumer feel the pain directly since oil is taking a bigger part of their wallet compared to the upper quartile. So the US consumer confidence actually dropped to a historic low of 48. Fresh number just coming out in May. However, on the corporate or manufacturing side, the PMI for March and April is still standing above 50. So it's kind of telling you that consumers are feeling this because kind of like they pay the gas price to go in and off work every day. However, corporate America seems to be still not being exactly impacted so far. And that's why I think Fed is basically watching that closely if that oil shock has been proliferated outside of just fuel or just the transportation price to other area.
I remember we talked about this at our last CIO series with Longview, where we discussed the first wave and the second wave of inflation. So
exactly.
I think the second wave is something the Fed has acknowledged, and we're also watching very closely, and that refers to what Wendy just talked about regarding into the spillover into production, into the supply chain, and pretty much all products, right? So do you see the CPI inflation widening this month?
Oh, well,
absolutely.
March? Well, absolutely. This what I'm showing here is the number also April. That's already 3.8. That's already jumped from March. I think that was 3 or 3.3.
Yeah.
Anyhow, but
are more items on the rise because of the higher oil prices?
Exactly. So back in March, all the CPI breakdown we're seeing, the inflation was just the fuel prices as well as transportation. However, if we look into April, we already see some other categories seeing a mild inflation, including the food category, especially the fresh food such as vegetable and fruit that kind of like rely heavily on daily transportation.
Yes, makes sense. And we expect probably more numbers to show this inflation shock going forward. So we need to watch very closely. In fact, we also have now created a inflation specific calendar. Anyone interested can contact UOB Hian representative to get a copy of that, where we will be focusing on any upcoming inflation-related data points from CPI to PPI and PCE and also the Fed FOMC meetings. We should have plenty of that coming up. Okay, so just to reiterate that so far we discussed more from the top-down angle, what uncertainty we see in the US market. And just to reiterate our continued cautious view on the US market because of this. And for the past 3 months, we've been highlighting to you, and Wendy, this is before you joined, including talking to a predecessor, Paul Davino, about the inflation shock, the rate uncertainty, and how that may cause a multiple contraction, right, in the US stock market. And I won't repeat it, but all these things, all these risks are still there. Plus, now we have the midterm election, right? And an Iran war is still no end in sight. Having said that, I think there might still be some good news out there, especially in the AI supply chain. Can you maybe give us an update, especially post earnings? I think we have a lot more information regarding how that ecosystem is developing.
Yeah, and as we mentioned, despite all up and down, earning revision is still the number one driver in the US market. So
especially AI earnings revision,
exactly.
AI related, right?
So yeah, being in a tech investor for pretty much throughout my career, so I'm trying to simplify this AI investment and trying to kind of like showcase a little bit thought process of how we pick winner, let's say trying to stick with the earning fundamentals.
Yeah.
So I'm sure you see this kind of like a similar kind of chart or being reiterated by Jensen Huang or others on how to dissect the AI supply chain from hardware to the infrastructure to application. But what I was trying to show here is trying to find what is the key driver in different part of the AI pie.
Yes.
Basically, it's different. In hardware, it's kind of simple. It's a simple supply and demand since it's all about the production. So demand coming from the infrastructure player, basically hyperscaler like Google, Amazon, Microsoft, as long as their CapEx plan is still intact, it means that your demand is still sort of sufficient. So the only bottleneck, or what we say the price mover in hardware, is the supply.
Yes.
So, and that's why we see on the hardware dissector trying to give a very simple kind of like a dissect or subsector of different part of hardware. You can tell that when one part having a supply shortage, that's related stock tend to rally a lot. Remember back in 2023, when Nvidia's GPU were actually the almost like hot commodity on the market, and that would have the Nvidia rally. And most recently for the memory super cycle we're seeing, also a result from supply chain shortage to not the high end, but the lower end, such as DRAM and NAND, and that pushing up their prices crazily. So I think that from a hardware perspective, just to look at where is the supply bottleneck will be the best way to help you to target the best stock in the specific period of time. Infrastructure layer, basically, as I say, is the demand or customer of those hardware. So that will kind of like based on the CapEx plan for hyperscaler, as I mentioned, as well as how do they scale up sufficiently through either improve their efficient power through networking, or just easily dissect or sublicense that to other players, such as the neo cloud. That's where a lot of people talk about nowadays. And eventually, I think that's also come to the question that how are the customer making money, or are they making money? Because that's always been the key question whenever there's a discussion of AI bubble. So I think the application right now, there could be some argument, but the biggest demand coming from is still the large language model company, so aka Anthropic, OpenAI, and Gemini. Anthropic and OpenAI pretty much take about, I think, more than 80-90% of the entire large language model revenue in the US. So any of the demand, and both coming to market this year, it's very topical. So any of their future growth guidance, their monetization upside would definitely help to drive this whole supply chain going forward, as we have seen this year. But model is not the only player, obviously, as we mentioned in our earlier this year about the software being oversold. So some of those software that's kind of like being a beneficiary or supplement of that, such as the database, such as the CDN that provide token, as well as cybersecurity, actually can also be complemented into this application rally.
Yeah, well, that's a really great overview. I just want to reiterate that, all the investment opportunities across this whole stack is really predicated on the AI capex remaining strong.
Exactly.
So and this is something we also kind of got wrong at the beginning of the year, because one of our predictions is about a potential AI capex slowdown. that slowdown, it was happening until the first quarter earnings. So I think prior to first quarter earnings, US AI CapEx is expected to grow 65% year over year. Now, it may sound like a high number, but remember last year was 70 to 75%. But since, like Wendy said, since the first quarter earnings, we probably see another leg up in the CapEx forecast. So I think on average, we're looking at maybe a 10% increase, a further 10% increase from there. So maybe there's no slowdown this year, but we don't know. There's also a counter view saying that, the guidance doesn't mean the hyperscaler can really complete the CapEx. That remains to be seen. So we are only in the middle of the year. We're not changing our prediction yet. Just to let you know that not all of our predictions came true. This one certainly is very controversial with the AI CapEx slowdown. And regardless, the absolute growth number still seems very high. Even 65%, right? And so even 60% that's a very high number, and that kind of supported the AI industry fundamentals, even supported the U.S. economy, I think, to a certain extent, and definitely support the U.S. stock market. So with that, related to the AI supply chain, there's no company more important than Nvidia. And I want to spend some time to share with you, Wendy and I's thinking on what's coming out in terms of earnings. They're going to report after market today, correct? And first quarter, the consensus of revenue about $70.9 billion, up almost 80% year over year, and earnings also up more than 80%. But remember, for these type of companies, as Wendy said, usually earnings get revised up. At the same time, investor expectation also goes up as we get close to the earnings date. So as much as we care about the consensus, sometimes we also need to look at so-called the whisper number or the buy side estimate. For Nvidia has been consistently high. So it is entirely possible today that despite the possibility of Nvidia beating numbers, they could still miss the so-called the buy side high expectations. So we don't know. And that's another reason that we often advise our clients not to trade Nvidia too much, right? Before earnings. If you want to take a big position in Nvidia, if you want to buy more Nvidia, our advice has always been just wait and see. You're not losing much by just waiting one more day to see the actual numbers, to see the actual market response. And another non-quantitative aspect of earnings, and Wendy, please feel free to disagree, which is my experience tracking these companies for the past few years, is that often is what they say that move the stock, not what they report. So number is important, but markets sometimes often pick on a certain words or to certain rhetoric or even the tone that people like Jensen Huang issue to the market. So that's also something we'll be watching, what wording he's using with respect to the guidance, the economic outlook. I'm sure someone's going to ask about the oil shock and the macro top-down risk. And lastly, I think part of the reason that the stock has been kind of range bound recently, is it? Yeah. Is that I think there's renewed fears of competitive pressure from Nvidia's peers. So this is something we've been written about extensively. In fact, if you guys remember our very first Nvidia report, we listed competition as the biggest risk. This is way before you joined. This is back in, I think 2024, May or April 2024. Anyway, so it is all within our framework, but it is still worth our monitoring. So that also gives us some something that we should track during today's earnings is what does the competitive landscape look like. And talking to our US tech analyst, Garrick, looks like the biggest threat remains from ASICs from Broadcom. And as you know, when we pitch Broadcom, we always said that Broadcom is a so-called hedge against Nvidia, because we now are looking at two technology roadmaps in AI computing. One is the GPU route by Nvidia and AMD, and the other is the ASIC route by Broadcom. And today, the partnership with Google and Broadcom are posing a real threat to NVIDIA GPU. So I think Google has something called TPU that's co-developed with Broadcom. That's making good progress and gaining market share. And so all these things combined needs to be monitored. Anything to add on that? What's your thoughts about competition for NVIDIA?
Oh yeah, I think of course now with seems like the market focus has been shifting a little bit from just training towards inferences. And along with that, you see some old competitors such as AMD or even Intel coming up emphasizing the importance of CPUs, as well as I think the recent IPO company Celebras also providing almost another way of or another route for inference. At the same time, I think NVIDIA still have something down in its pocket that could impress the market. Yeah. Remember, we are in this product cycle of Vera Rubin coming in. I think they already start to shift some testing to OpenAI this month. So any revised guidance based on the new product cycle could definitely help NVIDIA sentiment improve. Yes. And of course, now that I'm pretty sure everybody not only using AI as a chatbot, that you start to use them to generate video, generate image, create your music, etc., etc. In a multimodal world, actually, GPU still have its advantage to actually process those multimedia inputs.
Yes, so that's why we still like the video for the long term. Exactly. It is still a core recommendation. It's a very important company. It's a great company to own. Our message is just simply to wait and see one date for the earnings to really decide the position size. We stay invested in the video, but we always try to control the risk ahead of the earnings. We don't sell the whole thing in our model portfolio. We simply try to control the position size ahead of these key triggers. And lastly, before we turn to Q&A, in terms of the market impact, again, Wendy, correct me if I'm wrong, feel free to disagree, that my experience is that, the earnings, NVIDIA earnings is not just a key to the industry, but also to US market as a whole. And so tonight's movement, the post-earnings movement for NVIDIA may very well dictate how the U.S. market will trade in the next 3 months. This is not just an AI play. This now has become the cornerstone of the U.S. stock market. And I think even from that perspective, even if you don't like AI, you don't want to invest in AI, this is the data point you need to watch just for the overall U.S. market direction and sentiment, particularly. And like we said, a major part of the reason the market is at a record high is because AI fundamentals are still very strong, and this is a very important checkpoint to verify whether the fundamentals are still as strong as people think. Okay, with that, we will end our main session and to turn to Q&A. Yeah. If you have any questions about U.S. market, about what we talk about in terms of drivers in the second half, and AI industry fundamentals, NVIDIA earnings, please feel free to use the Q&A window to enter your question. Please enter your question manually using text, and we will answer them. See your post. Yeah, so there's a really good question on Intel position within the AI supply chain. Now, this is a great question. Yeah. And also I have to tell you, Wendy, sometimes when I did the webinar myself, you get one answer. Now you can have two answers. And we don't necessarily have to agree. So and the investor have more choices to judge yourself that which answer works for the best for you. You want to go first?
Yeah, sure. I think.
Do you like Intel first of all?
Frankly, for the two major themes that Intel is in both CPU and foundry, frankly, I find better player than Intel in both aspects.
I have to say I agree. I don't like Intel at all.
But I understand that, right? Because Intel is kind of like in a run on two sides. When we talk about fundamental, it does have a quite a nice earning revision this time. And also probably from a thematic perspective, there are discussions that could Intel be the very first SOE that Trump really wanted to build in US, well, compared to the whole China SOE system that takes 30 years to build. However, still from my perspective, it's a major hurdle I see in Intel is still on this foundry side, which I think the booking, right now it cannot really add any new capacity for the coming 1 year or 2 years, but I could be wrong. So right now, the foundry quality of Intel, let's not make it unfair to compare with the TSMC, but even with some
definitely not.
But basically the current quality in terms of the advanced node is definitely nowhere there.
Sure.
And also the capacity expansion on Intel is more capped than we thought.
Yes.
So all in all, I think Intel is a good run. If it's keep on revised earning, it will be a nice revision for a kind of like under pressure, non-performing AI hope of over the past 2 years. You almost can see a little bit short squeeze there. But from a longer...
Things are definitely getting better.
Yeah, things are getting better. Marginally improvement or say...
Yeah, marginal improvement off a low base. But I don't think Intel has proved itself yet. Right, with whether it can really sustain its well, you mentioned a couple of things. One is the CPU business related to AI. There's the CPU, and the other is the foundry business. I don't think they're profitable yet in foundry. And then all the so-called customer wins is just talk, right? Apple hasn't materialized yet. Has it been any real development there? We don't know. So maybe, to say the least, we need a bit of patience on this to wait and see for more clarity on how they're developing the foundry business as well as their AI strategy. On GPU, definitely they're not as competitive as Nvidia, right? Yeah. And then again, if any questions, I do want to ask you a question about IPOs. We didn't talk too much about IPOs. Do you think would that be a driver? First of all, would that be a driver for the U.S. market? Apparently, we have a lot more exciting IPOs. Last year was the Hong Kong market IPO year, and this year is now the U.S. market IPO. First, market direction and sentiment. Number two is, are there any particular IPOs that get you excited?
Oh yeah, definitely the 3 IPOs that's caught everybody's eye this year will be starting with SpaceX.
Yes.
That's going up in June already. And followed by the 2 large language model we mentioned, OpenAI and Anthropic.
Yeah.
So after, I think, the long ongoing trial with Musk and Sam Altman, OpenAI finally clear. Yeah. From my perspective, that's it definitely opening up a new narrative for the market. SpaceX, we have already seen some of the proxy stock for space development already rally in advance of SpaceX. And I'm been hearing very crazy number in terms of valuation, but something like definitely above 1.5 trillion for sure. So that's also kind of like raised the question that where's all that flow coming from? Are they going to attract from Tesla or others? Anthropic and OpenAI, I will be more interested in their fundamental number, especially back to the whole question of whether AI is a bubble, whether application can make money. Anthropic sort of already proven itself that's starting from, if we take the past 1 year of Anthropic, its revenue growth is actually 10 times.
Yes.
Based on the 2 business development, and OpenAI definitely follows suit from just focusing on the 2C business subscription towards corporate. And I think this monetization and their forward-looking guidance can definitely help the whole AI narrative as to proven that they are a way that the end application can make money, and they are making money.
Yeah, well, all three are very interesting to me. I think we also talked about last week at our Singapore IFA forum about it. Okay, so more questions. I think somebody asked about this on our Chinese CIO series yesterday too. The new IPO Cerebus, which competes with Nvidia, right? Which we just talked about the Nvidia's competitive threat.
More inference, I would say, compared to training.
Yeah, and then is it worth looking at? Yes. Is it worth betting on? I think maybe not. Several reasons. First of all, this is a new company and it's not particularly a big company, so we don't really have much transparency or not much you can judge from what happened in the past with this company. There's always a risk with IPO, even though we do like some of the large IPOs like SpaceX. For this particular deal, the Cerebus that because it's just newly listed, the disclosure is always an issue. And then I think in terms of the size and volume and scale, definitely nothing comparable to NVIDIA. And then for these type of companies, it's always easy to claim themselves to be a NVIDIA replacement or NVIDIA, another smaller size NVIDIA. But, whether they can really achieve the status, I guess it's a different story. Because the opportunity for these type of companies that there will be a lot of architectural changes with the GPU, CPU, LPU, and SRAM, and all the AI computing infrastructure. There's constant innovation. So this company can potentially take advantage of that. But to me, this is almost still like a startup. What do you think?
Could be. I mean, inference is already definitely top of mind for the AI infrastructure right now. So anything that can prove another path to go through that will definitely attract attention. But frankly, it depends on whether there's a shortage in there. And when we're talking about before in the hardware space, it's a shortage on supply side is the key driver for pricing. But are we seeing shortage in CPU to start with? Not really right now. So that's kind of like give you a question of how thirsty the market is for alternatives.
Yeah. And then whatever the competitive threat applied to NVIDIA also applied to these companies too. Though it's not like the competition is equal. So again, I'll reiterate our key call on Broadcom. We always position Broadcom as a hedge for NVIDIA, and to hedge NVIDIA's competition risk, I think Broadcom is the topic, because either way, one of these companies both will benefit from the continued AI CapEx growth, and especially like Wendy mentioned about the inference demand. Treasury yield. Wow, I was hoping for that question. How will increasing Treasury yield impact tech stocks and overall U.S. stock market? That is a great question, and surprisingly, the yields are back to a historical high. Is it yield? The 10-year yield has breached the tariff days, right?
Oh yeah, 10-year US yield is out now 4.6.
4.6 already. Wow.
4.6 already. And 30 years now 5.2. 5.1.
5.1. Yeah. So these are all very critical levels, and these are the levels that under so-called normal times will cause a crash in the stock market, as in April 2025. You can look at the chart, as in previous cycles as well. So interestingly, the stock market is extremely calm about it. Any thoughts on that?
Oh, well, we definitely, if we look at the last time we see the Treasury yield, this stretch was back in 2022 as well. And at that time, it's actually a little bit reversed. We see Fed start to increase our hike rate for I think 7 times that year. And then we see the high point of 4.6 for 10-year. more than five for 30 years at the end of 2022.
Yeah.
So this time, actually, Fed did not hike rate at all, and the stock market seems still be in a bull run. However, I think this is the difference between how debt market and equity market look at it. Debt market pay more attention to macro fundamental compared to the equity market, kind of look at more on stock specific idiosyncratic upside. So, I mean, looking at the consumer sentiment, looking at the inflation data, no wonder the bond market will be worried on what's coming next. Also, there's a supply demand issue. Remember, the biggest, other than the long-term like pension fund, long-term fund in US, a big customer for the Treasury is number one, the Fed, and number two, the international central banks, such as Japan. So
Japan had to sell to defend its currency.
Exactly.
The reason they have to defend its currency is because oil prices are above $100, and they cannot sustain with the weakening yen and the skyrocketing oil prices. That's just too much inflation pressure.
Exactly. So let's go back to the supply demand, right? Your biggest demand, Japan is selling, and
China's selling.
Already been selling all time long. And the Fed chair, everybody wondering, since Kevin Walsh is pro QT, basically quantitative tightening, not QE, people are wondering whether he will do the same this time to leave some window for rate cut. So that means that when the bond matures, they just basically don't renew it.
But I guess the question is really about whether you think the stock market will stop pricing in that.
We already seeing that actually. Since Friday, Monday, and I think past 2 days, there's nothing going wrong in earnings. There's no
fundamental news.
No news coming from Iran, no news coming from Hormuz. The only thing that's changing is because of this breaking point of the Treasury yield. And actually, the first time we see the 30-year Treasury yield being auctioned above 5%. It's definitely
that's not a good sign.
Exactly.
So I guess our conclusion is eventually, maybe already been reflecting the such risk. I guess the thing that we need to pay attention to is whether this will be kind of a one-time wake-up call to the market. I'm a bit worried about the market suddenly wake up to this and there's like panic setting, versus, or will the market gradually pricing that risk a more benign correction? Both could happen.
I think I've read one thing that's a term this whole market very well is now you see a conflicting factor of EPS growth versus rate growth. See who can catch up to one another.
Exactly. One is the numerator, the other is the denominator.
Exactly. See who can catch up to drive this in the driving seat for the market.
That makes sense because the rate to equity impact is not always straightforward. Unlike bonds, right? The bond is very simple. Rates go up, price come down. And then I want to make a final point about, I think this higher yield, according to our latest fixed income monthly, is correlated with higher oil prices. And as Wendy said, sometimes different markets pricing different things. And in this case, the fixed income market seems to be more worried about the higher oil prices, which led to higher yields. And then this also tied back to our view on the oil shock, the related supply chain shock, and which were leading to the first wave and the second wave of inflation pressure, leading to the higher yields. And let me just double check. This time, the higher yields is not a reflection of a strong economy, right?
No.
So again, right on. So we are talking about. Again, back to our key message about inflation being the number one macro risk to the U.S. market. Any final word?
I think you summarized pretty well.
Thank you. Thanks everyone for joining our today's call. As usual, the replay of this webinar will be available on our YouTube Wealth Vision channel. And if you would like a copy of our presentation today, please contact your UOB Kay Hian representative. Thanks again, everyone.
Thanks.
Yeah. Good night.